Hello, my name is Peter Mauthe, and I'm here to present Trademark Capital Management's review of the June 2024 FOMC meeting decision. Let's take a look at what they said today. First of all, the decision was to leave rates unchanged, and the decision was unanimous. This is no change. The market has already known this and expected it. The Fed's median forecast for interest rate changes between now and the end of the year is for one rate cut, and that was based on the fact that there were 8 participants who would vote for 2 rate cuts, 7 would vote for 1 rate cut, and 4 who would vote for 0 rate cuts. If you weight those appropriately, we come out to about 30 basis points of expected rate cuts for the balance of the year. This is a moving target, however, so we'll have to see how it plays out. But right now, this is the way the Fed is expecting the rest of the year to go. There was no mention, however, that was made as to when the rate changes might take place. However, the markets believe that there's a slight chance that there will be a rate cut in September, but most of the market participants expect the rate cut to happen in November. The Fed also came out in their statement of economic projections that the GDP forecast for 2024 is at 2.1%. Now, with the debt load on our economy, this is about full throttle for our economy. So the economy is moving along just fine. And their expectation for the economic growth in 2025 and 26 is at 2%. So they're not looking at cutting rates by a lot just to spur the economy, because the economy is going to be growing at about full throttle. The Fed did raise their inflation expectation, however, from their earlier forecasts, not by a lot, but by a couple of tenths of a percent. And this is more of a statistical issue than it is a concern from the interest rate market's perspective. Now, let's take a look at where the good news came today. The good news came in the fact that the core CPI inflation, which is important to the Fed, came out at 3.4%, yet the consensus expectation was 3.5. Not a big difference, but of great interest to the market that it was not a surprise on the high side. So the market is responding appropriately, both in the stock market and the bond market. Now, if we take a look at why the Fed pays attention to the core, this is a common topic. Why does the Fed take a look at consumer prices without food and energy? Well, this is a 10-year chart with the core CPI in red and the CPI, which includes food and energy, in blue. You can see that because food and energy are very volatile, we get a lot of volatility in the movement of the CPI that is related to these particular components. The core CPI is much smoother, but still reflects the general level of inflation. And this is why the Fed pays attention to the core, with the understanding that the core is indicative of what the underlying inflation rate is in the economy. Now, lastly, and we've taken a look at this after the prior meetings, and this shows that the 2-year Treasury note tends to pretty effectively anticipate what the Fed funds open market rate is going to be, or what the open market is telling the Fed that they should be doing. The 2-year note is reflected here in green, and the Fed funds is set by the Open Market Committee is in black. And you can see indeed that the 2-year rate, or the yield on the 2-year Treasury note, tends to precede the direction of Treasury or the Fed funds rate. Now, I think the more important part about this, beyond the fact that the open market rates of the 2-year note have been suggesting for a number of months here, which, by the way, is not surprising. that it can be a number of months, it can be a year or more sometimes, that the open market rates as set by market participants is lower than the Fed funds rate, indicating that the market expects the Fed to lower sometime in the foreseeable future. However, the market seems to really find this as a really optimistic and invigorating item in terms of economic activity. But note, if we go back all the way to 1995, major cuts in the Fed fund rate have not been ideal for the stock market. This was coincident with the decline in the stock market following the tech bubble. Here is the decline in Fed funds that was a result of the financial crisis. So this was a 50% decline in the stock market. This was a 55% decline in the stock market. Here we had a 30+% decline in the stock market when we had the decline in Fed funds, just as we were going into the COVID quarantine. So we don't know whether that's going to be the case this time or not, but historically, it has not been a really great thing. We'll have to wait and see. Lastly, you can reach us at trademarkcapital.com. You can follow us on Twitter, now referred to as X. You can follow us on YouTube and LinkedIn. And if you have suggestions for future short videos from us at Trademark, you can reach us through trademarkcapital.com. Thanks for joining us today.